Welcome back to the channel. So today we're talking about Nvidia, a company that just printed $216 billion in revenue, grew 73% year over year, and is generating more profit than most countries' GDP. On paper, this is one of the most dominant businesses in human history, but as the bull case has gotten louder, so have the cracks underneath the surface. So what I want to do today is walk through both sides, give the bulls their due, and then show you why I think the bear case is underappreciated by the market. This is not financial advice, I'm just sharing my analysis and my thinking. Let's get to it. So let's start with what Nvidia actually does, because it's evolved a lot. At its core, Nvidia designs GPUs, graphics processing units, originally built for gaming. But over the last decade, they've become the dominant supplier of accelerator chips for artificial intelligence. Their data center segment now generates 91% of total revenue. That's not a side business, that is the business. They sell the picks and shovels in the AI gold rush. And right now, almost every major AI model in the world is being trained on their hardware. Now here's where the bulls get excited, and honestly, I can't blame them. Look at this revenue trajectory. Nvidia went from $27 billion in fiscal 2023 to $61 billion in 2024 to $130 billion in 2025. And now, $216 billion in fiscal 2026. That's not normal growth, that's a parabola. They basically 8x revenue in 3 years. No hardware company in history has ever done anything close to this at this scale. And the profitability is staggering. Net income hit $120 billion for the full year. That's a 55.6% net margin. Free cash flow came in at $58 billion. The balance sheet is a fortress, $11 billion in total debt against $157 billion in equity. That's a debt-to-equity ratio of 0.07. The current ratio is nearly 4x. By every traditional financial metric, this company is in extraordinary shape. I'm not going to pretend otherwise. Alright, so the bull case is straightforward. Nvidia controls 90% of the AI training accelerator market. The big five hyperscalers, Amazon, Alphabet, Meta, Microsoft, and Oracle, have committed over $710 billion in combined CapEx for 2026. Meta just signed a multi-generational deal committing to millions of Blackwell GPUs and the upcoming Rubin architecture. The CUDA software ecosystem creates massive switching costs. And at a PE of 36 on 73% revenue growth, the PEG ratio is well below 1, which means on a growth-adjusted basis, the bulls argue this stock is actually cheap. Here's the thing though, every single one of those arguments has a counter. And that's what the rest of this video is about. Let's start with the demand picture, because this is where things get uncomfortable. The bulls point to $710 billion in hyperscaler capex as proof of insatiable demand. But here's what they don't mention, that spending is increasingly debt-funded. The Big Five raised $108 billion in debt in 2025 alone to finance this infrastructure, and capital intensity is now consuming 94% of their operating cash flows. That's not organic reinvestment of profits, that's leveraged speculation on future AI revenue. Now compare that to the actual revenue being generated by AI companies. OpenAI is doing about $20 billion in ARR, Anthropic around $9 billion. All pure-play AI vendors combined, less than $35 billion, against $710 billion in infrastructure spend. That's a 20-to-1 mismatch. So I'm not going to lie, that ratio makes me deeply uncomfortable. Now let's talk about Nvidia's moat, because this is the core of the investment thesis. The bulls say CUDA is unassailable, that no one can replicate 2 decades of software ecosystem lock-in. And for a long time, that was true. But here's what's changed. OpenAI's Triton compiler now achieves 90 to 105% of hand-tuned CUDA kernel performance. PyTorch 2.x, which is the dominant framework for AI development, has natively adopted Triton as its primary layer fusion engine. What that means in plain English is that the AI software stack is actively decoupling from Nvidia hardware. You don't need CUDA anymore to get top-tier performance. And that's not a theoretical risk. It's happening right now, in production code, at the biggest AI labs in the world. And this plays directly into the custom ASIC threat. Google's Ironwood TPU, Amazon's Trainium 3, Meta's MTIA, Microsoft's Maya, all of these are on TSMC 3nm, all in mass deployment. Custom ASICs already represent 37% of the data center inference market, and that's projected to hit 45% by 2028. Inference is the fastest growing workload layer, it's where the volume is going to be, and every hyperscaler is building their own silicon to serve it. Look, AWS already cut prices on its own H100 cloud instances by 44 to 5% in June 2025 to stay competitive with Trainium 3. That's not a company adding Nvidia capacity. That's a company building its own alternative and using pricing pressure to accelerate the transition. Meanwhile, Meta just signed a $100 billion chip deal with AMD, structured with a 10% equity option, which mirrors Nvidia's own financing playbook. The hyperscalers are actively subsidizing competitors to escape CUDA dependency. Now let's look at what's happening to GPU pricing in the market, because this tells you a lot about the supply-demand dynamic. H100 spot prices have collapsed from about $8 per hour at peak scarcity to $1.49 to $2.80 per hour by early 2026. The mathematical break-even for infrastructure providers is $1.65 per hour. Do the math, many operators are already bleeding cash on their GPU fleets. And when operators bleed cash, what happens? Forced liquidations. Secondary market GPU dumps. That destroys pricing power for the next generation of chips too. If you can rent last-gen hardware for pennies on the dollar, why pay full price for Blackwell? Here's another thing. The bulls don't talk about enough: gross margin compression. Nvidia's full-year realized gross margin came in at 71.1%. But in Q4, management reported 75 to 75.2% on a GAAP and non-GAAP basis. That gap tells you the Blackwell transition is already extracting a structural margin cost. This isn't a one-quarter blip. It's the math of building increasingly complex multi-chip packages with advanced chip-on-wafer-on-substrate packaging at TSMC. And when you layer on the China headwinds, the 25% revenue-sharing extraction on H200 exports, the 25% ad valorem tariff, the 50% volume caps, the margin picture gets even worse. If forward guidance prints below 70%, that's a structural reset, not a transition hiccup. Alright, this is the slide that really bothers me, and it should bother you too. Nvidia reported $120 billion in net income for the full year, 55.6% net margin. But free cash flow was only $58 billion, a 26.9% margin. That's a 28.7 percentage point gap. On $216 billion in revenue, that means roughly $62 billion in reported net income is not converting to cash. Where is it going? Some of it is working capital absorption, inventory buildup, receivables. But some of it appears to be unrealized gains on illiquid AI startup investments flowing through the income statement. In Q3 alone, Nvidia reported $31.9 billion in net income, but only $23.8 billion in operating cash flow, an $8 billion gap in a single quarter. When your reported earnings consistently outpace your actual cash generation by that much, it raises serious questions about earnings quality. And that brings us to something I think is really under-discussed: potential circular financing. Nvidia has deployed more than $53 billion across 170-plus AI transactions since 2020, including up to $100 billion committed to OpenAI. They've also structured a $6.3 to $6.5 billion take-or-pay backstop with CoreWeave. Total ecosystem exposure is estimated at around $110 billion. That's approximately 67% of trailing 12-month revenue. Now here's the question. When Nvidia invests in an AI startup, and that startup turns around and buys Nvidia GPUs with the money, is that real organic demand, or is it circular financing? For context, Lucent Technologies had a similar model in the late 90s, vendor financing that represented about 24% of revenue. It collapsed spectacularly. Nvidia's ratio is nearly triple that. I'm not saying it's the same situation, but I'm saying the structural pattern is worth watching very carefully. There's also a hard physical constraint that nobody can engineer their way out of: power. Gigawatt-class grid connections now require 3+ years of regulatory lead times. Hyperscalers already have GPU inventories sitting idle because the data centers they're destined for literally can't turn on yet. The power isn't connected. Nvidia's days sales of inventory expanded from 73 days in late 2024 to 103 to 105 days by early 2026. Quarterly inventory turnover dropped to 0.87x. That means chips are being manufactured faster than they can be deployed. And Nvidia has $95.2 billion in legally binding forward purchase commitments to TSMC. If demand slows or deployment bottlenecks persist, those commitments become a liability, not an asset. The AI Powerwall is real, it's structural, and it's not getting solved in the next 12 months. So here's the market's verdict so far, and I think it's telling. Nvidia's market cap has declined from $5 trillion to $4.31 trillion, a $694 billion evaporation despite 73% revenue growth and record profits. That's not retail panic selling. That's sophisticated institutional capital repricing cycle risk, margin compression, and geopolitical headwinds that consensus models are underweighting. When the stock goes down on the best numbers in company history, that's a signal. The market is telling you that the incremental dollar of revenue growth is worth less than it was 6 months ago. And a PE of 36 might sound cheap on 73% growth. But if that growth decelerates, and it will mathematically at this scale, you need to ask what multiple this stock deserves on $250 or $300 billion in revenue growing 20 to 30%. So what are the catalysts, the things that would confirm or deny this thesis? Number 1. Q1 fiscal year 2027 earnings. If revenue hits the $78 billion guide, but gross margin prints below 72%, and the free cash flow to net income gap stays above 25 percentage points, that's the bear case playing out in real time. Number 2. Hyperscaler CapEx guidance. Any public cut from Amazon, Microsoft, or Alphabet instantly invalidates the parabolic demand models. Number 3. The Rubin ramp in second half of 2026. If yields are strong, that's a bull catalyst. If chip-on-wafer-on-substrate packaging constraints cause delays while H100 spot prices keep falling, it's a bear catalyst. And number 4. Watch CoreWeave. If they hit a covenant breach or a credit downgrade, Nvidia's take-or-pay backstop gets activated, and the circular financing risk becomes visible to everyone. So let me bring this all together. Nvidia is, without question, one of the most impressive businesses of our generation. The revenue growth is real. The technology is real. The market position is extraordinary. I'm not disputing any of that. But what I am saying is that the stock at $4.3 trillion is pricing in a level of dominance and durability that the underlying data is already contradicting. Gross margins are compressing. Custom ASICs are taking share at the inference layer. The CUDA moat is eroding through Triton. H100 spot prices have collapsed. There's a 20-to-1 mismatch between infrastructure spending and actual AI revenue. And $62 billion in reported net income isn't showing up as cash. The market noticed it took $694 billion off the market cap despite the best quarter in company history. I've been bearish on this name, and the new data hasn't changed my mind. If anything, it's reinforced the thesis. The numbers are incredible on the surface. But when you dig into the quality of those numbers and the structural headwinds forming underneath, that's where the real story is. Thanks for watching this one all the way through. I know it was a lot of data, and I appreciate you sticking with it. Look, this isn't a situation where I'm trying to be contrarian for the sake of it. I think Nvidia is genuinely one of the most remarkable companies in tech history. But this particular setup, the margin compression, the earnings quality gaps, the ASIC competition, the circular financing exposure, it just stood out to me as something that deserves a real, honest examination. So I'd love to hear from you. Are you bull or bear on Nvidia at these levels? What am I missing? What am I getting right? Drop it in the comments. And if you got something out of this analysis, consider subscribing. I put a lot of work into these, and it helps more than you know. I'll see you in the next one.